I'm going to just start as I wait for the questions to come along. And really, I'm going to start off with Chewy. Chewy, your presentation, I think, is quite raised quite a lot of questions, and I'm going to start with this one with you first. This person has asked this question: if a husband and the wife buy a house together, and they put the name on the two persons, A and B, of course, husband and wife, automatically will 100% of the share of the house, if of A will be distributed, let me just rephrase this, if B, for example, will B, the wife, automatically get 100% of the share if A, the husband, share will be distributed to A as well. I think if he passed away, based on the will it pass to the husband's kin, next of kin, if we put it into the will?
Okay. Typically in Singapore, when husband and wife buy real estate, they will hold the property in what we call joint tenancy. Joint tenancy, the effect of that is that when any of the couple passes on, the survivor will take everything. And if it's a joint tenanted property, therefore it actually takes effect outside of the will. Sometimes people buy properties in the form of a tenancy in common, and the result of that holding is that upon the passing of one of them, the share remains in the estate of the deceased, which can then be therefore subject of distribution under the will. So you have to check your legal title to see whether the property is owned in joint tenancy or as a tenant in common.
And a lot of questions here regarding, we'll just carry on with Chewy in terms of how, in terms of setting up a trust, how the trust manager, what sort of fees is charged typically in terms of setting up a trust and a trust manager?
Setting up trust, there are two sets of fees. One would be the setup fee, and that could, in my company, range from $3,600 to about $10,000. All depends on the complexity. And the second set of fees would be the annual fees, and that's usually a percentage of the trust fund, that is the amount of assets that is put into the trust. So if you put in $1 million into the trust fund, then our current rate of charges would be 0.5% per annum. So it's usually expressed as a percentage. Yeah, thank you.
Okay, great. We'll come back. There's some more questions here. But I'm going to start off with Mr. Ang here in terms of talking about the share builder plan. I think some of them were asking, is the returns guaranteed or anything with the capital protected, or is there any form of minimum lock-in period in terms for the share builder plan?
I need to clarify. Just now I gave an illustration 6%. That is not the guaranteed 6%. I'm trying to illustrate if you get 6%, your $100, it compounds to a certain amount. That doesn't mean the SBP guarantees or capital protect. So it's totally not that way. So I want to clarify, because just now when I was outside, there was a lot of questions. Is guaranteed at 6%? No. No, it's not guaranteed, not capital protected. It's just like you buying any other shares, just that this SBP allows you to buy in very, very small $100 amount, $200 amount. And you'll still be subjected to the fluctuations and everything else. This is just to facilitate investors to buy small amount. Okay, and there's no lock-in period. You can be participating for 3 months, 4 months, 10 years, 20 years, up to you. And like I say, this one is a very disciplined approach for long term. So I hope it clarifies. There's no capital protection, no guarantee. It's just buying shares in small, manageable amount.
All right, so I hope that clarifies. I think it's a way, it's like a dollar cost averaging, is that correct? Dollar cost averaging, all right? So it helps you to not So therefore, you find. So basically, in this case, do I still need to do fundamental analysis based on the stock counters? Do I still need to do that? Check the stock? Do I need to monitor the stock based, rights announcements, etc.? It's not exactly a passive thing, right?
Okay, one way to look at it is the company has already pre-selected. Now, if you look at the 20 names, they are the very well-known blue chip style of counter, pay regular dividend. It's not the penny type of stocks. These are the regular, very recognizable, most of them are index counters. So these counters are already, in a sense, blue chips recognized names. So I suppose you don't really have to worry in terms of fundamental. No? Do we have to worry about fundamental of DBS, of OCBC? So the counters are already pre-selected by the company.
They help us already, more or less, like some homework has been done.
Oh, definitely.
But does it mean that I don't do any of my homework?
Well, when you choose to participate in the program, then you have to look at the counter. Okay, like, do you choose between OCBC or DBS? No, so in a sense, there is still some choice that you have to make. But the difficult part has been conquered by Philip. We already pre-selected the stronger counters. So I suppose less work on your part. You have to decide within the 20 counters which one you want to be participating in.
All right, so I think we still, as we said, you still need to do your own analysis, all right? Still can't run away. Okay, Sam, you were talking a little bit more just now about the portfolio construction. And so in terms of recommendation for the percentage for the different portfolios, would you talk about and look in terms of emergency fund, the core, tactical, and reserve portfolio? Could you just give some sort of guidance in this case?
Okay, I think as I mentioned earlier on about the portfolio construction, right? Let's just take an example. Let's take someone that has a growth risk profile. In this case, I would suggest, as I mentioned earlier on, a 70%, 30% allocation into growth and income assets. So how does this translate into portfolio construction? If I were to construct a portfolio using the 70-30 allocation, 70% into growth assets, 30% into income assets, my strategic portfolio, or the core portfolio, will consist entirely of the 30% fixed income or income assets. I would also allocate a certain percentage of the growth assets in the strategic portfolio, and allocate about 10%, the remaining 10%, just 10% of the initial capital into your tactical portfolio. The rest will go into the reserve portfolio. So just to sum it up, 10% into tactical, 30% of the income assets that I mentioned earlier will go into the strategic portfolio. Remaining amount will be split between the strategic growth assets as well as the reserve portfolio. How much money should we allocate for emergency fund? Emergency fund typically is about 3 to 6 months of your income. Are there any rules of thumb? I would usually say that for someone that is starting out, in terms of savings, do allocate or do save 10% of your monthly income. And when I talk about monthly income, it is net income, not gross income, because we have to factor in the CPF contribution. So 10% of your net income, you save it on a monthly basis, initially stream it into the emergency fund until you have accumulated about 3 to 6 months, and then you start, and then the remaining portion you'll stream it to the savings portfolio.
Hope that clarifies. Chewy, back to a question again to you. Talking about wills, do I need a lawyer to actually construct the will? And and in this case, if I have a CPF, will it be automatically passed down to my children?
Well, wills are an instrument that can be drawn typically by lawyers, but they can also be the offering of will writing companies. And so a company like mine, Rock Wills, we do a lot of wills on a daily basis. So that becomes a specialization of the company. Of course, your lawyer may be engaged in various kinds of work. Wills may be something that he do occasionally. And so obviously the choice is for the consumer. We do it as part of what we call estate planning. In other words, the will is but one of the instruments in the total estate planning solutions. And the second part of the question is CPF. Okay, CPF is distributed according to the CPF Act, meaning that there is a nomination process. So it bypasses the will, and even if you say that in a will, it will not be of effect. The distribution will purely be via the nomination form. And if you didn't put in a nomination in the CPF form, then it will be treated as a distribution under the intestacy by the public trustee. Okay, thank you.
By the way, if you didn't nominate yet, my NRSC number is Singapore 1713117. Okay, another very interesting question. I mean, this is I'm going to take this to Mr. Ang in terms of which is better. All right, should I put in terms of a regular savings plan, the amount, say, $100 a month for 5 years, that works out to $6,000, or do I put in $6,000 into a blue chip, a selection of blue chip stocks when the market is the bottom? Assume that you're able to cash the market, assuming obviously you can catch the market at the bottom of a crisis. Could you please share some thoughts on this?
I would suggest do both. Well, because if you, the thing is, A, you are doing $100 every month, and B is you already have that $6,000 you can deploy immediately. So the thing is, if you can do both, do both. Because some people can only do A, because they can only do $100 a month. They don't have that immediate $6,000. So if you are in the situation A, please start doing the A, $100 a month, keep on accumulating. Now, if you can already have $6,000 immediate you can deploy, then here the question stated, assuming you can pick the bottom. Now, so assuming, so how do we know when is the bottom? And just now outside, I was speaking to a group. In my own trading, I said, trade what the charts, trade not how we feel, but what we see. Trade not how we feel, but what we see on the chart. Okay, because I'm a chart reader, so how do I call the bottom? Very simply, I reveal a big secret now. Now, if you are familiar with technical analysis, you put in a 10-month moving average. As long as the price close above 10 months moving average, buy. Close below, sell. Okay, and over the past 15 years, the signal has only come 4 times. Buy signal 4 times. 4 trades in 15 years. 97 crisis, 01, the terrorist attack, 03, SARS crisis bottom, 09, subprime crisis bottom. Only trade 4 times. So how you call the bottom? Yes, 10-month moving average. How you call the top? Okay, each bottom will come with a top eventually. Close below 10-month moving average, sell. Simple? Yes, nobody follows. Too simple. That's why I said boring is good, but people refuse to accept that it's so early. It's so easy. So the question, I think, here, if you have ready funds, yes, you can call a bottom. Now you can market time. So which one is a better strategy? No, it depends on the individual circumstance.
I have a better strategy. Get educated.
Oh, yeah, definitely.
All right, Chewy, again, I told you a lot of questions for
right,
you.
good,
I
sure.
told you. All right, so, all right, now this person, right, suppose this person has a daughter, and he or she leaves 1 million spread over 10 years. So it's set up as a trust, say payable, say 100,000 per year in a trust. If the daughter after 3 years, say the daughter is married, by the way, and gets, has a divorce after the 3 years, and then in the trust payable is still a balance of 700,000. Is that trust considered part of the matrimonial assets that her then former whatever husband, whatever you call it, make a claim on the share of the 700,000?
Okay. Generally, for matrimonial division of assets, inheritance would be disregarded. The problem comes when one of the couple actually takes the inheritance and mix it up with their own assets and apply the use of that asset into the pool of family funds. So when you mix it up with your own money, then that's where it could be treated as a matrimonial asset for division. So if you have a trust, you know that the monies will sit in the trust funds, which will be held in the name of the trustee. So the daughter would not be able to say that that remaining $700,000 is for her free use. The trustee usually have a discretion to actually also withhold any distributions. So it doesn't make sense when the trustee makes payment out of a trust fund and it goes into the hands of the creditors of a beneficiary. The trustee would do the right thing by actually holding off payment until the adverse event takes away. So the answer to that is that no. If the daughter gets into a problem with her husband and in the matrimonial division, the trust assets would not generally be included as part of the division.
That's interesting. Okay, that's good to know. I mean, Sang, there's a question here, quite interesting in terms of, I think we would say, part of the share builder plan in terms of Keppel Corp. And then part of the issue is that they issued, I think, part of the rights issue as dividend, K-REIT share as part of the dividend. Then how would you treat this K-REIT share that's given out? That was, under the share builder plan, especially how would you treat this as part of the overall thing?
Okay, for the share builder plan program, the shares that you buy regularly each month is kept custodian in Phillip Security in your name. The shares do not go to CDP. So the shares are kept in Phillip as your custodian. So in this case of Keppel Corporation, when it distributed K-REITs as dividend, so this dividend will actually come into your custodian account. So the dividend can be in the form of cash, can be in the form of other shares. So because this this issue is in the form of K-REITs, so the K-REITs come into your custodian account within Phillip. So if in future there is other instance of this distribution in other shares, it will come into your custodian account in Phillip Security. Yeah.
I'm going to ask this question. I think there's one question here. I think, Chiwi, I told you there was a question here regarding one of your slides. What basically is referring to the family reserves and resources. What do you mean by the family reserves and resources in the wealth transfer in that slide in the estate planning?
Well, what I'm saying is that the wealth left by the parent can certainly be held in a trust, and in which case the monies will then continue to be invested and accumulated and grown so that it behaves like a reserve fund for the rainy day. So you never know what circumstances of your future beneficiaries would be. Suddenly, the beneficiary get ill, sick, cannot work. So that's where the reserve monies can then come out to supplement their lifestyle and maintain them. So it's really, trust funds should be seen in a sense. Money is to be controlled and distributed for the important things in life.
So when you work with your client, you actually generally go through with them in terms of what their needs are, in terms of giving them some certain advice, in terms of what they would like to achieve, in terms of what they like to see after they've gone, or even when they're still here.
I mean, certainly it's important to have the trust fund invested as well. Trustees tend to be very conservative in the approach to investments, and generally we're looking at fairly long-term horizons. So we're not, monies in the trust funds are not meant to be exposed to very risky assets so that they may be lost very quickly. It's meant for fairly long-term, and preservation of the capital is one of the key objectives when you set up a trust fund.
Sam, you meet a lot of people during the course of your training. What are some of the things that you would like to share with this audience in terms of the main thing they will take away from this session, from this last couple of days, and what we've been doing the last day? Could you just share that one thing, the one takeaway for investors?
I think if there's one takeaway that I want to share with all of you, is that before you start to embark on, or you start to execute any investment decisions or any trading decisions, please do your homework. Please do your homework. Get yourself familiarized and acquired with the relevant product knowledge. Understand the mechanism of how the product works before you execute the decision to buy or sell. Now, there's also another thing that I would share with all of you, that I want to share with all of you, is that when it comes to investing, especially when it comes to investing in equities, gold, REITs, and fixed income instruments, etc., and on the other genre, we talk about trading forex, futures, etc. Do note that different products exhibit different kind of characteristics. And these characteristics must be compatible with the level of risk that you can assume, and also in conjunction with your investment time horizon for you to make money, for you to create wealth effectively and efficiently.
Mr. Ang, I'd like to ask the one thing that you want investors must take up in the last session or the last couple of days, the one thing that investors should take away.
I tend to agree is educating yourself, know what you're getting into, and perhaps I've been a trader since 19 years old, but the older I get, I'm still young, the older I get, I tend to want to do it more simply. When I'm 19, when I'm 20, I want to be trading every day. I want to be calling my broker every 30 minutes. Now, I'm 43, I'm telling people, no, don't look at the charts. Don't look at the computer screen every day. Every Saturday, just look at it once. Look at the weekly chart. Don't look at the minutes chart. Don't look at the daily chart. No. 4 trades in 15 years. And every time at the bottom, you have a realistic way to get you into the market. Then you just ride the trend. When it's time to get out, you just get out, go for holiday. When it's time to get back in, get back in. When it's time to get out, get out. No, don't have to stare at the screen for every day. Unless you are doing forex trading, spot trading, then that's different. But no, it may sound very simple, but really investing is just about knowing when to buy, knowing what to buy, and knowing when to sell. So knowing when to buy is, for me, is simply catching the market cycle. But how do you get the cycle? Now, when the cycle is up, you need to know what to buy. I advocate buying high to sell higher. I don't buy those at the bottom, those charts without heartbeat at the bottom. You do not know when it will happen. So I buy 52-week high. Buy high to sell higher. Controversial. but I think it works. Those who are in the market long enough, right? And the thing is, you need to know when to sell. Before the party is over, better get out first. How do you know the party is over? When everybody wants to talk to you about stocks. Now, nobody dare to buy stocks still. Okay, so this is my personal opinion. Get yourself educated. Attend many courses. Read on the internet. Go and attend more seminars. Attend more seminars. Ask a lot of questions. Because that's how I learned. 19 years old, you just get knocked around, lost a lot of money. Then when you feel the pain, then you realize, hey, I better spend some serious time learning about the market before. I see many young people. I mean, I have a heart for young people. I mentor some young people. And I shared a story about my daughter at 15 years old learning about the stock market. And which young girl at 15 wants to learn about stock market? No. Well, you got to get your children at, those 50s, uncles, aunties, get your children started early, attend courses, go for seminars, just send them, don't then, I mean, this is my personal opinion, but I think, well, it's good advice.
Good, we'll make sure we bring children next time. And then, Chiwi, from your vast experience, from your practice and your business, in terms of what you have seen over the years, what are some of the things what is the one thing could you share with this audience today? What would, for the takeout in terms of one thing they need to know based on your experience with your practice?
The one thing is that, well, it's your hard-earned money, and you've worked hard for it. And life is going to be really competitive in Singapore. Your children got to make lives on their own. And you could, as a parent, therefore, build up that pool of reserves that could supplement their lifestyles when they need it. But they need to work. They need to earn their own lives and make something out of their own lives for themselves. The trust fund that you have set up for them will go a long way to help. And at a time where prices are going up and up, you want to have that fund, the rainy day fund, in many years to go. Thank you.
Thank you. Ladies and gentlemen, could you please give my panel a round of applause, please? It's been wonderful for you to stay right on this. Sam, Zhang, and Chiwi, thank you very much for joining us this afternoon. Thank you for staying to the end. I appreciate in terms of your feedback forms, if you could actually give back the feedback forms, we'd like to hear from you. We will be having more videos as well. This whole session will be videotaped and actually online in 2 weeks' time on the website. At the same time, we do have workshops right across the week. Find out more about it. Thank you very much and have a good evening.